with a topic called cost of capital. And the first source of capital we're going to deal with in this problem now is the cost of debt. Now remember, the cost of debt, the relevant cost of debt to a company is the cost of debt after taxes. So it's going to be the cost of the debt in the market multiplied by 1 minus the tax rate. Now, the cost of the debt in the market is really the yield on the bond when the company sells the bond in the market. The thing you have to remember about all these securities, whether it's bonds or stocks or whatever it is now, the price that the company receives is referred to as the net price. And that's the price that the investment banker sells the security for minus the flotation cost, the cost of the investment banker giving you their services. And at any rate, though, you need to remember that it's the net price that we're talking about from the company's point of view. Now, this first problem reads this way. It says, currently, Warren Industries can sell 15-year, $1,000 par value bonds paying annual interest at a 12% coupon rate. As a result of the current interest rates, the bonds can be sold for $1,010 each. Flotation costs are $30 per bond, which will be incurred in this process. The firm is in the 40% tax bracket. And the A part says find the net proceeds from the sale of the bond. That is, they want you to find the net price of the bond. The B part says show the cash flows from the firm's point of view over the maturity of the bond. So we're going to work those two parts of the problem first. Now they tell us in the problem now that the bond sells in the market for $1,010. So this is what the investment banker is selling the bonds for. On the other hand, the investment banker is charging us $30 a bond to sell the bonds. What's the net price? What is the company net from selling a single bond? Well, it's the price in the market, $1,010, minus the flotation cost of $30. So the answer to the A part is $980. The other thing I want you to understand about bonds now, we talked about this in a previous chapter. A bond is an interest-only loan. That is, as a company, you're going to get a certain amount of money, and then you'll pay interest only for a period of time, and then you pay back all the principal that you owe. And so they want you in the B part now to lay out the cash flows of the bond, and that this is in this case, what the company would have to pay out in the future and what it gets from selling the bond today. And as we just found out, at time period 0, the company is going to get a positive cash flow of $980 for every bond that it sells. What does it have to pay in return for that money? Well, at the end of every year for 15 years, it's got to pay the annual interest they owe. And the annual interest on a bond is the bond's stated return, its coupon rate, in this case 12%, multiplied by the face value or the par value of the bond, which they tell us is $1,000. So 1,000 times 12% is $120. Now the company will pay only the interest every year until the end of the life of the bond. This is a 15-year bond. At the end of the 15th year now, the company's going to owe the bondholder the face value of the bond, which is $1,000. So today they get $980. To get that much money, they're going to have to pay $120 at the end of every year for 15 years. And then also at the end of 15 years, they're going to have to pay the face value of the bond, $1,000. And that shows you the cash flows that will accrue to the company, both the inflows and the outflows.